over time, gold and silver hold their value for an investor. In recent years, silver's lagged gold a bit. In other words, they both made major lows in 2015 and have advanced significantly since then in an arm wrestling manner. In other words, it's been, if you're too focused on what this month or next month's going to do, you're panicked out of the market, every other month. And there's many technicians out there who encourage you to exit the market because it's a top or it's going to correct big, etc. But actually, it's been now 10 years and gold has gone from 1,050 to 3,500. So ongoing with it had a 20% correction in the middle of that. But silver has lagged, especially since 2020. Silver reached up just below 30 and then pulled back from 2020 to 2023, while gold really went sideways, and therefore silver underperformed gold. That's changing, and I think it could change dramatically. And if you go back and look, for example, 50 years ago, and look at every year and figure out what is the price of silver in relation to gold, divide 1 ounce into 1 ounce, and what is that percent? And you'll find that 21 of those 50 years, silver was at least 2% of the price of gold. Well, right now, silver is 1.16% of the price of gold. It's coming up from a low that was below 1%. So silver recently has been very, very low. So you ask about silver, I think its prime dynamic right now is it's going to catch up to the mama metal. It's going to be the better place to be, especially I think between now and the end of this year. Quite a move. It's going to continue. And if silver merely returned to the 2% level, that would be right now standing still. It means it's going to almost double from where it is now relative to gold. So it's double better than gold right now. If silver merely returns to its more or less normal relationship to gold. But in bull trends in silver and gold, like in 79, 80, or 2010, 2011, in those latter years of the bull trends, silver went ape on the upside. It went up to 3.5, even one time up to 6% plus the price of gold. So, and I say this is also going to be true with the gold and silver miners. They're going to outpace gold because they've underpaced gold for the last, since mid-2020. But I think it's indicative of the initial wave of doubt that there is in the U.S. stock market. No, it got up and made a new high recently. We're extremely negative on the U.S. stock market. I think it's topping. I think it's been topping since late 24, early 25. We're marginally above those highs, but I still think it's topping. But that money goes somewhere. And historically, if you go back and look at major bear markets in the stock market, you'll see gold did quite well. In fact, it was one of the few places to be during those bad periods. And to some extent, that's not just because money's moving out of the stock market and seeking a new home. It's also because central banks, whenever the stock market starts to implode, they will naturally start to cut rates and do anything they can to liquefy the system, to protect those assets that they deem worthy of protection. They don't care about commodities. Heck with commodities. Corn farmers can go broke. We don't care if price goes up there. But we got to keep the prices of stocks up. Okay. Also, when the stock market turns down, that's when the data points, things like unemployment or economic indicators are indicating the weakening in the economy. That's when the data points go south. So the stuff that Powell's talking about that he needs to see before he can cut, bet on that happening after the stock market starts down again. And that's when they'll start to do what they always do. And if you go back and look at 2007 top, 2000 top, the dot-com, before the market really started to implode, the Fed started cutting rates. They'd been on pause for a year or two, and then they suddenly put pedal to the floor. Let's print the money. Let's do QEs, whatever. It did not help the stock market. That money flow went into monetary metals. And it's not that gold had to wait for that event, because it's been rising for 10 years. Again, it's an issue that over decades and decades, gold holds its value to the degrading money unit.
The funny thing about markets is they always seem to find a way to humiliate the largest number of people possible. And if you've been watching gold and silver over the last decade, you've seen exactly that in slow motion. If you zoom in month to month, it's been an arm wrestling match. A tug of war between panic sellers and those few stubborn folks who understand that the real trend isn't measured in weeks or even quarters, but in years. And the ones who've stayed the course have seen something quietly extraordinary. Gold has gone from roughly $1,050 in late 2015 to north of $3,400 today. That's over a tripling in value, even with a 20% correction in the middle. But if we're being honest, silver has been like that friend who says they'll meet you at 6 and strolls in at 8. Since the big pandemic run to just under $30 in 2020, silver basically treaded water. Actually more like dog paddled backwards, from 2020 through 2023, while gold just wandered sideways and held its ground. That meant silver underperformed its big sister, the mama metal as I like to call it. But here's the shift. That lag is ending, and when silver decides to move, it doesn't just play catch-up. It tends to overtake the lead in spectacular fashion. Look back over the last 50 years. Run the math on the gold-silver ratio. That's simply the price of silver as a percentage of gold. Out of those 50 years, in 21 of them, silver was at least 2% of the price of gold. Today, about 1.16%. We were recently under 1%, which is bargain basement territory historically. Just moving back to the 2% mark, without gold moving an inch, would mean silver almost doubles from here in relative terms. And in bull markets for monetary metals, silver doesn't stop at average. In the blow-off phases, think 1979 to 80 or 2010 to 11, silver's percentage of gold's price didn't just nudge past 2%, it went to 3%, 3.5%, and even briefly over 6%. That's why I'm telling you, between now and year-end, silver is setting up for something special. It's not just the ratio argument, it's the behavior of the miners. Gold miners have been a bit like the silver market since mid-2020, underperforming while gold chops sideways. But lately, they've started to lead again. You plot something like GDX, the gold miners ETF, against gold, and you'll see a breakout in the spread. A clear move that says, hey, we're done lagging. And when miners in silver start to outperform gold, it's usually a sign you're entering the more explosive phase of a metals bull market. Now, all of this is happening against the backdrop of a US stock market that, frankly, looks tired. Sure, the S&P poked out to new highs recently, but structurally the market has been in a topping process since late 2024 or early 2025. Tops in major equity markets aren't a moment. They're a process. It's like watching a celebrity career implode, one bad headline at a time, while their publicist insists everything's fine. Here's the historical pattern. When stocks roll over, the Federal Reserve panics. They might not call it that, but that's what it is. Rates start getting cut. Liquidity is pumped in. They don't care about commodities in general. Corn farmers can fend for themselves. But equities get the royal treatment. Remember 2000? Remember 2007? In both cases, the Fed had been on pause for a while, trying to look responsible, and then, whoosh, pedal to the floor, rates slashed, QE programs rolled out. And while that kind of policy might not save stocks in the short run, it tends to light a fire under monetary metals. That's why I say you don't have to wait for the crash to own gold and silver. These metals have been in a decade-long uptrend already, quietly adjusting to the ongoing degradation of the currency unit. Because let's be real, over decades and decades, the dollar has lost purchasing power against almost everything tangible: land, food, energy, and certainly precious metals.
I think silver had its cleansing pullback in April. Now, that's when it tried to, or some investors assumed that if the stock market goes down, silver must go down too. So they dumped on silver. And if they did, they got their neck ripped off, because within days it shot from 27.50 up to 30, 31, 32, 33, way off that low. And then finally emerged through the old dual highs at 35 that we had October last year and March of this year. And now we're living up at close to 40. I don't have an ultimate target for the bull market. I do have a pretty solid assumption, philosophically based on my libertarian views and what I've learned in time about gold. This time, gold and silver are going up, but they're likely not to come back down. In other words, you're not going to get a bull market peak and a major bear market that follows. This time, I think the global outcome, the U.S. outcome in particular, economically speaking, monetarily, will be totally upsetting to assumptions, to institutions, and to a lot of investors who don't realize what's going on. This is not a normal boom-bust cycle. This bust will not be normal in the stock market. It is based on a 15-year bull market, one of the oldest in U.S., in fact, the oldest bull market in U.S. history, printed in place by M2 growth and Fed funds rate taken to zero for 10 or 15 years. And even after they upticked it, a year or so ago, it was at levels that are in the lower quadrant of the past 75 years of rates. So we've had effectively free money for 15 years. Well, that's like getting drugs in your arm. You get hallucinated, hire employees, you build new factories, you make all kinds of positive assumptions based on the underlying value of the money unit, which is, it's rapidly decaying, but the nominal value seems good. And the cost of money, a factor in any business decision, heck, it's free, or next to free. So errors are made, personal, corporate, government, etc., and compounded. Not only is the age of the bull trend like triple any prior bull market, its increase in price, the multiple gain is far more than the 23 to 29 bull, or the 1994 to 2000 dot-com bull, or the 2002 to 2007 peak that preceded the mortgage crisis. There's no comparison. So we have the biggest bubble, especially in U.S. market now. I'm not talking about a lot of other markets that don't have bubbles. But when it's in our lap, and that's the biggest lap to be in, because when we expunge the errors that occurred in that period of time. Gold knows what central banks are going to do. That's what they do. They print, they save their governments, they try to save their government debt markets. They take any steps they have to that continues to distort the underlying real value of the money in your wallet. Gold is the only alternative, and silver. And therefore, this time around, I think at the end of this, I think it's going to be institutionalized. I think we're going to end up with gold-backed currencies and silver-backed potentially around the world, here, there, and pretty soon everywhere. Once this crisis hits full blown, then people will say, this hasn't been working. Let's go back to gold. So instead of a bear market next time, you'll have gold as institutionalized. You can go back and research this yourself. Punch up a monthly or a weekly RSI of gold and silver. But during the massive surges, like 79 to 80 or 2010, 11, those readings got rammed to the roof. And they were overbought for maybe 5-6 months straight in a row. And that's the time you made the most money, is when they were, quote, overbought. What we look at is structure of momentum. And by that, I mean, when we plot momentum, what we do is we take the price action, like a bar chart of price, daily, weekly, monthly, whatever. Usually we're focused more on long term.
So let's push further, because the real story here isn't just that silver is undervalued relative to gold. It's that the mechanics of this market are setting up for something that could make the 2010 to 2011 spike look tame. I've said before that metals bull markets tend to have 3 phases. The first is the stealth phase. That's where informed investors quietly accumulate while the mainstream ignores it. We've been through that. Then comes the awareness phase. More participants notice, the price grinds higher, sentiment improves. That's where gold's been for much of the last decade. But the last phase, the mania phase, is where silver becomes the life of the party. And in every cycle I've studied, when silver moves into that final stage, it tends to go vertical. If you go back to January 1979, silver was trading around $6 an ounce. By January 1980, it hit $50. That's over an 8-fold move in a year. Now, yes, the Hunt brothers played a role in that frenzy, but the point stands. The silver market is so small compared to gold that when money pours in, it simply can't absorb it without massive price moves. The 2010 to 2011 move from $17 to almost $50 in under 2 years is the same lesson in modern form. And here we are again, with silver starting from a historically low percentage of gold's price, industrial demand in a multi-decade uptrend, and a financial system that's getting shakier by the month. One of the more interesting side effects of a stock market rollover is the change in investor psychology. People who've been conditioned for 15 years to buy the dip in tech stocks start to realize that dips can keep dipping. They begin looking for alternatives that aren't tied to corporate earnings or the next Fed-fueled rally. And while real estate has been a go-to in past decades, the combination of high prices, high rates, and demographic headwinds make it less attractive now. That's where gold and silver step in, not just as hedges, but as liquid, globally recognized assets that don't depend on a third party's promise to pay. You'll sometimes hear skeptics say, but gold doesn't pay a dividend. True, and it doesn't declare bankruptcy either. In a world where counterparty risk is rising, think regional banks, think over-leveraged corporates. Having part of your portfolio in something that's just itself is a feature, not a bug. Silver shares that feature and adds the kicker of industrial demand. If gold is the insurance policy, silver is the insurance policy with a built-in growth engine. Now let's talk miners, because they're the leverage play on this entire thesis. In the last few years, miners have lagged bullion badly. Part of that was cost inflation, energy, labor, equipment. But margins expand dramatically when metals prices move higher and costs stabilize. The last few months have seen miners start to outperform gold again. That's important because in past cycles, sustained outperformance by miners has been a leading indicator that the bull market is entering its acceleration phase. And when miners and silver lead gold, history says you're looking at a strong, sustained advance. Here's something that often gets overlooked. The gold-silver ratio doesn't have to move back to its long-term average in a straight line. In fact, in the blow-off phases, it tends to overshoot in silver's favor. In 1980, the ratio dropped under 20. In 2011, it got under 32. Today, it's still north of 80. Just getting to 50 would be a major re-rating for silver. If gold were at $3,500, that would imply $70 silver, without any speculative overshoot. But if the ratio dropped to 30 in a Mania and gold held $3,500, you're looking at over 115 silver dollars. And that's still below its inflation-adjusted 1980 high. I know what some of you are thinking. Okay, but won't governments and big banks try to suppress that? Of course they will try. They've been trying for decades. But here's the thing about suppression. It doesn't eliminate the underlying pressures. It just bottles them up. The longer it goes on, the more violent the release when it finally breaks. We've seen it in currencies, we've seen it in bonds, and yes, we've seen it in metals. The COMEX and LBMA can play paper games all they want, but physical demand eventually forces their hand. When contracts start standing for delivery in size, when ETFs see massive inflows, when mints report record sales, that's the real market speaking. This is why I tell people not to overcomplicate it. You don't need to be watching every tick, trying to time every squiggle. If you believe the macro backdrop, debt overhang, currency debasement, deglobalization, then you understand why owning metals is not a short-term trade, it's a long-term strategy. And if you can get in before the mania phase, you don't need to catch the exact top to make a life-changing return. Let me give you another perspective. Central banks themselves have been buying gold hand over fist. The World Gold Council reported that in 2022 and 2023, central banks bought more gold than in any year since records began. These aren't Reddit traders chasing a trend. These are the stewards of national reserves, repositioning for a different global monetary order. And while central banks don't typically buy silver, their gold buying indirectly supports silver by reinforcing the monetary metals narrative. You might have noticed something else. Geopolitical tension has gone from being an occasional flare-up to a constant background hum. Whether it's trade disputes, sanctions, or actual armed conflict, the result is the same. Countries want to reduce their reliance on other nations' currencies and payment systems. Gold is the obvious neutral reserve asset for that. Silver benefits from the same distrust of fiat, with the added bonus that it's too small a market for most governments to stockpile in size without pushing the price up. That makes it more of a people's metal, but also more volatile when sentiment shifts. I also want to address the opportunity cost argument. People say, well, if I put money in metals and stocks go up, I've missed out. Maybe, in the short term. But opportunity cost cuts both ways. If you stay 100% in equities and we go into a multi-year bear market, you've missed the chance to be in the asset class that's rising while stocks fall. And unlike in the 1970s or early 2000s, today's starting point for stocks is extreme. High valuations, concentrated leadership, and an economy that's already showing late-cycle characteristics. That's not the environment where you want to be all in on growth narratives. If you want a taste of how fast sentiment can flip, just look at 2008. Gold started that year around $840, dropped to $710 during the initial liquidation panic, then finished 2009 at over $1,100. Silver went from under $9 in late 2008 to nearly $20 by the end of 2008-2009. And that was before the really big move in 2010 to 2011. The common thread? A financial system under strain, central banks cutting rates and printing, and investors realizing they needed exposure to something real. I can't emphasize this enough. The move we're setting up for now is happening from a much higher starting point in gold and a much more compressed starting point in silver. That's a dangerous combination for anyone underweight metals, because catching up once it starts running is emotionally and financially harder than just getting in before the fireworks. And here's a little reality check for those thinking they can just buy the dip in metals once the mania starts. Dips in a mania are shallow and brief. In 1979 to 1980, silver's pullbacks were often measured in hours, not weeks. In 2011, there were corrections, but they were vicious. Sharp drops followed by even sharper recoveries. If you were waiting for confirmation, you were left behind. So where does this leave us? In my view, we're on the cusp of silver moving from being the underperformer of this cycle to being the star. Gold will continue to do what it's been doing: grind higher, hold value, attract institutional flows. But silver has the potential to multiply faster, both because of where it sits in the gold-silver ratio and because of the thinness of its market. Miners will amplify those moves, and for those who can stomach the volatility, the reward could be significant. Let me wrap this up with a tweet-sized thought. Gold is the anchor. Silver is the sail. When the wind picks up, the sail outruns the anchor every time. If you take the long view, ignore the short-term noise, and position yourself before the crowd, you're not just betting on a price move, you're aligning with a multi-decade trend of currency debasement, shifting global trade, and the remonetization of tangible assets. And when that alignment meets the mania phase, history says the results can be extraordinary. This isn't financial advice, and it's not a promise. It's just the reality of how these cycles have played out before, and why this one, with all its unique macro catalysts, could be even bigger. Don't wait for the history books to tell you what happened. Be in a position to read them from a beach somewhere, smiling.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.